Just hold your thoughts there. I've got a special guest, Subir Gokarn, joining us live right here on ET Now. Thanks very much for being with us, sir. But let's just talk about Q1. 4.9%. Expectations are we could end fiscal by 2.6%. Is Q1 then an outlier, like Agam said early?
Well, I think the trend towards a lower CAD over the next 3 quarters is reasonable, because there has been sharp depreciation that should result in a pickup in exports. While the US may not be recovering as strongly as was earlier believed, it is recovering, so that suggests that the markets for Indian exports, for all exports actually, will improve somewhat over the next couple of quarters. So these factors should contribute to some narrowing of the deficit. 4.8 in 1 quarter is more or less the same level it was, or 4.9, more or less the same level it was for the whole of last year. The last quarter of last year was, I believe, 5. The big deltas, the big contributors to that sharp rise in the CAD over the last 2 years essentially came from 2 new minerals. We're already dealing with the pressure of 2 old minerals, oil and gold. And now we're dealing with the additional pressure from iron ore, that is the reduced exports of iron ore and the increased imports of non-coking coal or steam coal. And those 2 factors have not gone away. We are seeing some revival of iron ore mining in the areas where it was previously banned, but nowhere to the extent that it was at its peak. And on the coal front, we are still basically in a situation where we're importing substantial amounts of coal for power plants. So the pressure, I think, is still on, and we shouldn't be looking at a very, very dramatic reversal unless, even if steps are taken to address these pressures, they will not show results in short order. They will take time to materialize. So I think the pressure is on. The question is whether steps that will correct it, that will ease it, are being taken, and I think that's what the priority should be.
Subir, the government had earlier talked about a current account deficit of 3.7 for this year, and now there's talk about 2.6. So what are the factors that you think could have affected this dramatic decline in the estimate for this year?
Well, I think again, I'm not necessarily sort of endorsing those calculations. I haven't really looked at the underlying assumptions. But the 3.7 assessment was made perhaps 2 or 3 months ago, at a time when the rupee had not depreciated to the level that we're seeing it now. It's obviously stabilizing or showing signs of stability now, partly because of, and importantly I think, because of the announcement by the Fed last week or week before last, and the expectation that liquidity levels will continue to remain quite buoyant in the global economy. So that has taken the pressure off the rupee, but the depreciation over the last 6 or 7 weeks will obviously contribute to an increased export competitiveness, and some sectors like software are basically not going to face too many constraints in terms of rapidly expanding exports. Manufactured goods will face some constraints. I think the potential to increase exports of manufactured goods are there, certainly, is there, whether it's textiles and garments, whether it's leather goods and auto components. Auto components, I think, have great potential because all of our component manufacturers are already linked, plugged into a global supply chain. But there are infrastructure constraints to keep in mind. There are power issues, there are transport bottlenecks, some of which will dilute the benefits or the potential benefits of a rupee depreciation. So, but overall, I think there is a reasonable expectation that exports will respond quite positively to where the rupee is now, and that would allow for some scaling down of the absolute deficit forecast. Now, how much it's going to change by, I think, is something for sort of deeper analysis to suggest.
Absolutely. Subir, one factor that has contributed to a greater stability of the rupee has been the report that the US has kind of temporarily at least deferred its tapering. But another factor that has contributed is the direct window for purchase of purchase of dollars by the oil marketing companies. Now these have all been swaps. We don't know when the swaps will mature. So as and when they do you anticipate volatility again returning to the forex market?
Yeah, I think this is basically another way of intervention. It's another way of pumping dollars into the market to curb volatility. So instead of doing it directly, it's being done through a special window. Now, obviously, these dollars have to be returned. As you said, this is a swap, not a direct sale. And the expectation, the hope, I presume, is that when supply of dollars, which is essentially inflow of foreign investment in any form, returns, that is the time when these swaps will be executed. So obviously, all of this depends on what happens to the domestic investment climate. If we are looking at a steady and a sustainable increase in inflows, liquidity is already in the picture, and there is a risk from tapering sometime in the future. When that's going to be, we don't know yet. But the other side of the equation is the attractiveness for foreign investors to invest into India, and that means the usual things. That means policy changes, reforms, signals, all of the things that we've been talking about for the last several weeks. That are needed to restore investor confidence. So those two, of course, need to go hand in hand. By selling dollars directly with the expectation that these deals will be reversed in the future, underlying that is the expectation that inflows will also improve.
Dr. Gokarn, a very quick question since we've begun talking about the currency volatility. One of the fears that really did weigh on the Indian currency was CAD and the government's ability to finance it. Now that the fears around erosion of inflows have been substantially taken care of, or at least for the time being, do you believe the worst is really over for the Indian rupee?
I think the basic concern is not so much whether the inflows come or not, and clearly that has helped enormously in providing stability over the last few days. But the basic concern is the vulnerability that a large CAD creates. So if the CAD remains where it is, and we're looking at a continuation of this trend, which is around 5%, slightly below 5%. Any shock that emanates from the global system, whether it is tapering or even, for example, we're talking now about a US shutdown, a government shutdown, and the prospect that the debt ceiling will not be increased, so the US may actually technically default on the government may technically default on its obligations. Now, we don't know what sort of disruption these events may create in global markets, but when we have this kind of vulnerability on the current account, any such disruption, however small it may be, however temporary it may be, tends to have a magnified impact. And I think we have to focus on, while we are certainly, I think, legitimately looking at trying to stabilize inflows and financing the deficit, we have to put a lot of priority on reducing the deficit, because that's really where the vulnerability comes from.
For the very first time, people in Finance Ministry, including the Minister and the Department of Economic Affairs Secretary, are beginning to talk about a number for the rupee. $59 to $60 is what we've heard in the last 2 weeks on multiple occasions, seems to be the real value or the right level for the rupee, according to the Finance Minister. He's never really put a number to it, now he is. Do you think we will get back to those levels of 59 to 60?
I think the fact that global liquidity conditions have, in a sense, returned to what they were before May 22nd, when the first indications of a possible taper were provided, would suggest stability. Where that stability is to be found, I think, is a much more difficult number to project. But what is going to move the rupee from where it is, it appears to be stabilizing now, which is roughly in the 62-63 range, to that 59-60, and I don't really know what the basis of this number is. But if it is to move to that level, then we've got to see two things happen. One is there has to be some strong signal that the current account deficit is being addressed. It may not be immediately dealt with, but at least a credible strategy is put in place, which naturally tempers expectations, which impacts expectations. But the second is that there has to be more capital coming in some fashion through either investment or through greater borrowing, however it is. But unless these two things happen, so if underlying that projection is presumably a belief that either one or both of these things is going to happen. So in that sense, that would be a good sign if the government is committed to announcing certain measures, whether it is on the gold front or the coal front or the iron ore front, I don't know which one. All of them have their challenges. But if some combination of measures is announced which have some credibility, which investors take seriously, then I think we could visualize a re-rating and a sustainable re-rating of the currency, which is what might take it to these higher levels that are being talked about.
Subir, this morning we had Mr. A.V. Rajwade on our show, and we asked him how would he like to see the rupee value 5 years down the line, and his guess was 100 to the dollar. Would you like to stick your neck out on that?
No, I don't have any short-term or long-term view on the rupee. I think it is ultimately the manifestation of some underlying fundamentals. It is a manifestation of the supply and the demand for dollars. And I would like to see us reduce our vulnerability to these sharp movements as much as possible, which means getting a handle on the current account and then creating the conditions necessary for sustainable, robust, productive investments in the economy. And whatever happens to rupee as an outcome of those two developments, I think is an outcome that I'm happy to accept.
All right, you're happy to accept the outcome on the rupee. Before we let you go, one final question on the current account deficit. Plenty of concerns around CAD. Do you now believe
the outcome based on those factors?
Yes, but do you now believe from where we are, those concerns are a little over-exaggerated?
What concerns?
The concerns around CAD, from where we see things now, with the possibility of gold imports coming down, with oil imports being curbed, with exports picking up, tweaking happening on non-oil imports. Do you think some of those concerns are over-exaggerated? About 2 months back, there seemed to have been a balance of payment crisis in India. Are we done with staring at one now?
I think there is clearly an element of self-correction when the currency has depreciated so much. That's bound to happen. So the fact that it appears to be happening is not very visible in these numbers, but that's the expectation that people are working with for the next few quarters. That's good. There's no question that that's a positive development, and that should abate some of the concerns. But I still think that we have to be focused on why the current account deficit went from below 3% of GDP to almost 5% in 2 years. And the two big contributors of that, I keep repeating, are iron ore and coal, and those are going to, if we don't do anything about them, the CAD may come down somewhat, but the basic vulnerability, I think, remains, and I think we have to address it.
Subir Gokarn, always a pleasure to have you right here on ET Now with your perspective today on the Q1 CAD numbers. They seem to be an outlier, at least for now, but many people expect those numbers to come down. 2.6% looks very aggressive, like the government has been boasting.